Hi accounting class. In this video we're going to go over a problem right from your textbook on treasury stock, regular common stock, and cash dividends. Okay? Alright, so over to the board I have the particulars of treasury stock. So let me get out of your way. Alright? And just pause right now and take some notes on this. Okay, so let's talk now that you've opened up your pause. All right, so treasury stock is stock at one point was issued and now it's being purchased back. Why? What would be the reasons? Well, they want to avoid a hostile takeover. So the issue when you issue your common stock is that if you issue too much, more than 50%, another company can overtake you. So they want to be careful of that. If they see that their issuance of common stock is getting to that 50% to one particular company, they're going to want to avoid that. So they're going to purchase back their stock maybe from other individuals, thus keeping their control. So to avoid a hostile takeover, they want to give stock options to executives. So a plus when you're working for a company, if you're a really good employee and they want to keep you, they give you stock options. And they say to you, you know what, you've got this stock option, but you have to work here for at least 3 years before it vests. Another reason is that on the open market, currently their stock is selling very cheaply. And so they just want to purchase it back, keep it in their treasury, and then later sell it at a higher price. Another reason, they want to improve their ratios. So they're looking to improve some of their ratios. All right, I didn't list them all, but I wanted to give you a basic idea of treasury stock before we begin. Okay, here's what's really important too, classification. All right, so let me circle this. The classification of treasury stock. It is a contra equity account. All right, so one more time. Any contra account that I teach you is always the opposite of a regular account. So it will show under equity, but it's a contra account. It will show the opposite. So treasury stock, you will learn, will subtract. Okay, what's the normal balance? It's a contra equity. You have to know debit and credit. So it's the opposite of equity. Its normal balance will be a debit. So NB equals debit. Okay? So before we begin, you want to understand what you're doing before we start crunching these numbers. Okay, so now I'm going to erase. And we're going to go to the problem straight from your textbook. Okay. All right, so the problem we're going to go through is exercise 10-29A. All right, so please have it open when I'm going through it. Here's why. You're going to work in the lab, and they're just going to throw this information at you. So you want to understand what you're doing. All right, so I'm looking at the problem, and here's what it says. Account for the issuance of stock. Show how treasury stock affects a company. Account for dividends. Here's what it also says. At December 31st, 2018, Atlantic Corporation reported the stockholders' equity accounts shown here. So they're showing you the stockholders' equity for the company. Okay? All right. Here's what they're showing. I see common stock, and I see a $3 par value. Everybody write that down. You know that's really important. We have to watch that number when we issue common stock. It says 21 million shares are currently issued. At 63, this is probably rounded to millions. So 63 is all it is, but it stands for 63 million. Paid in capital in excess of par, 32 million, retained earnings 245. Okay, remember that's millions. Treasury stock at cost is currently 20, and then they have total stockholders' equity is 320. Okay? All right. Okay. So, then it's giving you a series of A, B, C, D, and E. It's asking you to journalize the Atlantic transactions of Part B, C, D, and E. Okay? I'm going to point out A to you. Everybody's going to be paying attention. Explanations are not required, so I'm not going to make us explain why. Number 2, what was the overall effect of the transactions? This is very important. They're only looking at the letters A through E. We did need the additional, we needed the existing information in the stockholders' equity. However, they're not going to have us figure it out on that. They're only going to have us figure it out for the effects for A through E. Okay, so here's the first one. A, net income of 444 million. Okay, great, but I'm not going to make a journal entry for that. Okay, I need to know that because net income gets closed to retained earnings. Retained earnings is an equity account. They are going to be looking at the overall effect on stockholders' equity. So I only need the accounts that will be affected stockholders' equity. Everybody, please write that down in your notes right now, though, that 444 million will affect retained earnings. Okay, so now we're going to go to B. It says issuance of 4 million shares of common stock for $14 per share. Okay, remember, whatever you issue common stock, whatever it's sold for will always be the cash piece. So I'm going to go to the board, and for B, I have to do a journal entry. So I go over to the board, and I put debit, credit, and this is for B. Remember, I already talked to you about what happens with A. We'll use A later on, not yet. B, so cash, I'm going to debit. I am going to take 4 million and multiply it by 14, and that gives me 56. Okay, remember this is rounded to millions. Then I'm going to take my common stock. I'm going to credit my amount to common stock. Be careful. I look at the problem. What are they saying the par value for common stock is? $3. So I am going to take the 4 million and multiply it by 3. I take 4 million, multiply it by 3, that is my common stock. 4 million multiplied by 3 gives me 12 million. Okay, the difference between the two will be my paid in capital in excess of par. Okay? And that is 44. I'm going to try to write small so I can show you at the very end. Okay. That's the answer to B. Now I go to C. Here's C. Here's what it says. Purchase. All right, everybody stop right now. Look at B. B is issuance. They're issuing the common stock. C, completely different. That says purchase of 5 million shares of Treasury stock for 60 million. Okay, this is Treasury stock. So I look, they purchased 5 million. Okay. All right, so I'm going to go over here and I'm going to debit Treasury stock. Why? Because Treasury stock is a contra equity account. I'm purchasing it back. I am increasing my Treasury stock. To increase Treasury stock, I debit. So I put over here 60. Then I credit cash. 60. Okay, I'm going to grab my red marker. Okay. Here's why. Everybody, this is really, really important. Okay. Trying to do all this in once. All right, so I'm going to star this. Everybody star. This is not in the lab. This is for your notes. Okay? All right. When you purchase back Treasury stock, par value is gone. Okay, so that $3 par value is gone. The new value is whatever you purchase the Treasury stock back at. So I go over here and they don't give it to me. They don't give me how much they purchased it back for. They're going to make me figure it out. So I go over here and I'm going to take the 60 and I'm going to divide that, all right? I'm just kind of starring that. That's, you might think I'm multiplying. So I'm going to take the 60 and I'm going to divide that by the number of shares they purchased back. 5 million. I divide it, 60 divided by 5, that gives me 12. All right, everybody, you're going to do this in your notes. The lab will not make you do this. Do this or you will get very confused. Okay, so now, every time I sell back, until I reach that $5 million, I am going to use $12. My new cost for this Treasury stock is $12. Okay? All right, so I look at the next problem. Sold 2 million of the Treasury shares purchased in Part C for $28 million. Okay, so this one, they tell you what they sold it for. They don't make you figure it out. All right, so they told you it was $28 million. So I'm gonna do this in red. Okay, so I'm gonna do, this is for D. I'm gonna do cash for 28. Okay, all right, now Treasury stock. This is what a lot of students get wrong. It's because they're not understanding. Treasury stock. You're going to take the value that you purchased it back at, which is $12, and you're going to multiply it by the number of shares that they issued. So they reissued of this Treasury stock. They sold it back out there. They sold back out 2 million shares. So I'm going to take 12 times 2. Okay, the 2 million, and that gives me 24. Okay? All right, so my cash is 28, my Treasury stock is 24. Well, the difference is paid in capital, but everybody label this Treasury stock. I'm going to abbreviate it. The lab will have Treasury stock. You take the difference between the two, and that is 4. Okay? All right. The last thing that it says declared and paid cash dividends of 32 million. So think of accounting 1. When you affect the statement of retained earnings, right? Dividends, what does it do? Dividends decrease retained earnings. So you're going to make a journal entry. How do you decrease retained earnings? You're going to debit retained earnings. So I go over here. And let me change now. This is, let me change with my marker. So I'm going to do E. Now, the lab, you can do it either way. You can declare the dividend and then pay it at a later date. Okay, so one more time. What I'm about to show you is they declare the dividend and they pay it at a later date. Here's what you will do. You will debit retained earnings. For whatever they said it was 32 million. Okay, I'm going to run out of room. And you would credit dividend payable. This is if you didn't pay it right away. And that is 32. Okay? All right, let's look, let's stop. Retained earnings, you're debiting, you're increasing, well, you're actually decreasing that account. You're decreasing retained earnings, but you've already made that entry. You made that affect retained earnings. You're crediting dividend payable, you're increasing, you're going to eventually pay it. So when you pay it, here's what you do. You're going to debit dividend payable, look at your entries, make sure they make sense. And that would be 32. And you're going to credit cash 32. Okay? That's an example if they declare a dividend and they pay it at a later time. I'm going to step back. Look at your entries. You're going to debit retained earnings, credit dividend payable, debit dividend payable when you later pay it down, and credit cash. Okay? All right. Now, I'm going to erase. If they paid this dividend immediately, so the lab will let you do it either way. So now I'm going to show you if they pay the dividend immediately. Well, guess what? The retained earnings will be the same. So I'm going to erase. The only difference is you're going to credit cash and you're done. All right? You don't have to do any liability because you paid for it. So you credit cash. Okay? Yep, and 32. Okay, so let me step back. That's an example when they declare and pay the dividend immediately. Okay, now it's going to ask you, let me put this down. What is the overall effect of all these journal entries on stockholders' equity? Well, guess what? Remember, we didn't do a journal entry for A, but A does affect stockholders' equity. That would affect retained earnings. So what the problem is looking is a final number that you come up with in order to tell them the impact of these entries plus A on stockholders' equity. So let me go over here. I'm going to put it right here. This would be requirement 2. Okay, I'm going to start with the 440. Okay, so that was in A. Don't forget that. I start with 440. That's net income. That's good. That's going to be a positive number. Okay, now, next, I'm going to look over here. So I have common stock and I have paid in capital, right? So the two of those I would add. I'm going to show you those separately. So those would be positives. The 44 would be positive. Let me draw a line so you're clear that this is separate. Okay, now I look at this journal entry. What happened? Oh, I debited Treasury stock. Well, guess what? That's a contra equity account. So Treasury stock, I want to put in parentheses. Put that in parentheses. Okay? Then I look. All right, what's my next one? All right, Treasury stock. Well, now I'm selling it back out there. So it's no longer Treasury stock. Just so you know, it changes into common stock when you sell it back out. But right now, you will label it Treasury stock. Still label it Treasury stock. But they're crediting that. That will be a positive number. Okay? I look here. Paid in capital, what happened? I credited that. That is $4. Okay? Then I look. Here's my last one. Retained earnings. What did I do? I credited that. 32. I'm sorry. I debited retained earnings. 32. Okay? When I debit retained earnings, I better put that in parentheses. That's subtracting from my equity. All right. They're only looking for the total overall effective equity. So you'll take 440, you'll add in 12, you'll add in 44, subtract 60. That's a contra equity account that's going to subtract from equity. You'll add in 24, they sold it back out. You'll add in 4, paid in capital, that's a equity account. You're crediting that, you're increasing. and then retained earnings I debited, I will subtract. So the final total of all that is 432. Now remember, in the lab, that's what they're going to be looking for. They want to look for that total. Okay? And that's it. That's how you do that problem. It is a tough problem. Make sure you're understanding each piece, and I'll see you in a later video.